Let us see the next question. A Limited acquires T Limited. On the date of acquisition, position of both the companies were as under. Information is provided with respect to two companies, A Limited and T Limited. Earning information is given, price earning ratio is given, market value is given, number of equity shares, per share market price and per share earning is given. The first question is, what is the market value of the merged firm? That is the first question. And so on, further questions are provided to us. So let us have discussion about the market value of the merged firm. I request all of you to pay attention. I'll have some initial basic discussion with you with respect to the different methods that we have for market value of the merged firm. And then one by one we are going to have understanding that's how to calculate the same. Dear students, with respect to the market value of the merged firm, we will be provided with one of the four information. We will be provided with one of the four information. The first information that may be provided to us is price earning ratio of the merged firm. That is the first information that can be provided to us. If at all we have been provided with the price earning ratio of the merged firm information, then in that case, how to make the calculation of MPS, that is what I am discussing with you. Dear students, we know as far as the price earning ratio is concerned, formula for the price earning ratio is market price of the share divided by earning per share. So as far as the market price per share is concerned, it is earning per share into price earning ratio. So the market price per share is calculated as the product of the earning into PE ratio, if the PE ratio information is given to us. So what will happen? First of all, the MPS of the merged firm will be calculated as EPS of the merged firm into price earning ratio of the merged firm. We already have understood that the EPS of the merged firm can be calculated as earning after taxes of the merged firm divided by number of equity shares of the merged firm. Earning might be increasing, it may not be increasing, whatever may be the situation that would be provided to us, that we are required to consider. The second information that may be provided to us will be the present value of incremental earning and or savings of expenses. This is what's the next information that may be provided to us. Present value of the incremental earning or so the present value of the savings may be provided to us. Dear students, we understand that say whenever any information comes in the market, then in that case immediately its effect is observed in the current market price of the equity share. For example, we understand that say soon after say the Russia and Ukraine war, the companies which are exporting goods say in Russia, the sale of that company is going to fall down, and because of that, so the profit of the company will decrease and dividend to the investor will fall down. With that, so the price of that equity share will immediately fall down. See, we do not know that say for what time period the war is going to last. We do not know that say exactly how far the sales is going to be affected. However, so soon after this kind of say any event, the price of that security will fall down immediately. We understand that so the companies which are that is the exporting goods in Russia, the currency of that country is falling down, and with that so the price of equity share of that company will definitely fall down. What I want to say is that say whenever this kind of corporate action like the mergers or acquisitions take place, then immediately a market is having a kind of so the discounting of the future advantages of the same, and its effect is observed in the current market price of the equity share. we understand that say soon after the news had come into the market that say there is say some like the like issue with the Maggie product with respect to the quality. Soon after that news comes in the market, for the very first time the price of Nestle company is say falling down. The reason behind that is say the Nestle companies say one of the major product is Maggie, and because of that say there is likely to have an impact. Sales will fall down, profit will fall down, and the returns to the investor will also decrease. Any of the like the event that takes place nationally or internationally say may have the impact on the individual company, or they may have the impact on the overall market. So immediately the effect of the same is say like it will be reflected. We know that in the March 2020 also say it happened like this that soon after the COVID news had come and initial lockdown say had taken place, everybody was frightened that say this will that is last for a very long period and it is going to have very bad impact economically. So the Sensex had gone down substantially. So coming back to the point, say we may be provided with this kind of information. If such kind of information is given, then in that case, market value of the merged firm will be found as market value of A plus market value of T plus present value of incremental earning and or present value of the savings. That is the way we are required to make the calculation of answer. Third information that may be provided to us is this. Dear students, we may be provided with information as far as the target company is concerned. Whatever the rate at which it is growing right now, let us say it is growing at the rate of 10% right now. However, there is an expectation that say with the merger, say the growth rate of the target company will increase, let us say to 12%. In a way that say the product or the idea of the target company is excellent. However, it may be having say the lack of say reaching to a like number of customers. It does not have say the good network. So as far as the acquiring company is concerned, it may be able to say take the advantage of the large network that it has, and because of which the growth rate of the 10% will increase to 12%. So what will happen? So the value of the target company will increase say due to merger. In such situation, say we are required to make the computation of market value of the merged firm as market value of A plus revised market value of T. So what will happen, dear students? We are required to take into account a revised growth rate to compute the valuation of the target company once again. And with that, so the market value of the merged firm will be found. This is the way we are required to do answer. And the last situation is a kind of situation that say we have over here in this question, wherein none of the three information have been given to us. If none of the three information have been given to us, then in that case, the market value of the merged firm is simply the summation of the two independent market values. That is 20 plus 8, that comes to 28 lakhs. This is the way the answer is required to be found. Then on heading, market value of merged firm, in that write down, first point, with respect to market value of merged firm, comma, we may be provided with one of the following information. उसमें लिखो ए प्राइस अर्निंग रेशियो ऑफ मर्ज फर्म, बी present value of incremental earning or savings of expenses given. C change in growth rate of target company is given. D the last situation is none of the above is information given. Second point, in case of D situation, comma, market value of merged firm will be found as under. उसमें लिखो मार्केट वैल्यू ऑफ ए प्लस मार्केट वैल्यू ऑफ टी। ऐसा करके मार्केट वैल्यू ऑफ द मर्ज फर्म कैलकुलेट किया जाएगा। So let us start calculating answer of this question in which we have to compute the market value of the merged firm. So I request you to write down answer for the first question. Market value of the merged firm is equal to market value of A plus market value of T. 20 lakhs plus 8 lakhs. That comes to 28 lakhs. The second question is you are required to calculate the gain or benefit due to merger. That is a question. Now dear students, what is the gain or benefit due to merger? Friends, in second part of the question, we are required to find gain or benefit due to merger. Let us understand that से कैसे कैलकुलेट किया जाएगा वो। Gain or benefit due to merger is indicating what is the increase in market value of the merged firm in comparison to the market value of A and market value of T. उसको gain और benefit due to merger बोला जाता है। It means that over here, say we do not take into account that say acquiring company को क्या फायदा हुआ or what is the advantage to the target company. We do not do that say the separate working. We understand that say the gain or benefit due to merger is indicating that say in total what is the increase in the market value of the merged firm in comparison to market value of A and market value of T. So write down answer. Gain or benefit due to merger is indicating an increase in market value of merged firm in comparison to market value of both the companies before merger. So it will be found like this: market value of merged firm minus market value of A plus market value of T. This is the way it is calculated. 28 lakhs minus 20 lakhs plus 8 lakhs. So in this example it is 0. With paragraph write down, gain or benefit due to merger is calculated in total, comma, not from A or T company separately. Full stop. This is the way it is calculated. Third question. You're required to compute the MPS of the merged firm, MPS attributable to the shareholders of each firm, profit or loss to the shareholders of each firm if the exchange ratio is 0.20 and if exchange ratio is 0.60. So for these two exchange ratios, we are required to make the computation that what is the MPS of the merged firm, what is the MPS attributable to the shareholders of each firm, calculation of the profit or loss to the shareholders of each firm. So there are three questions that you are required to answer for the different exchange ratio. Try to calculate answer of both the questions on your own. Then I'll do working for you and put your answer in the chat box. So understanding the answer of the first question, in which we'll compute the MPS of the merged firm. It will be calculated as market value of the merged firm divided by number of shares of the merged firm. We already have calculated the market value of the merged firm. It is an amount of 28 lakhs divided by number of shares of the merged firm is number of shares of acquiring company plus number of shares of the target company into exchange ratio. This is the way we can compute the number of shares of the merged firm. There are two exchange ratios that they have provided in the question. The first is the exchange ratio provided to us as 0.20 and second is the exchange ratio which is provided as 0.60. This is the way the two exchange ratios are provided to us. So in the first case, what will happen? It is 28 lakhs divided by number of shares of the acquiring company, which is provided as 10,000 plus number of shares of the target company is 12,500 into exchange ratio 0.20. On the other hand, it is again 28 lakhs divided by number of shares of the acquiring company are 10,000, number of shares of the target company are 12,500 into 0.60. So I request you to use your calculator. 12,500 into 0.2, that comes to 2,500 plus 10,000. So it is 12,500. So 28 lakhs divided by 12,500. So the market price per share is rupees 224. For the next one, it is again 28 lakhs. Divided by the number of shares of the merged firm would be 12,500 into 0.6. 7,500 plus 10,000. That comes to 17,500. 28 lakhs upon 17,500. So it is 160 rupees per share. This is the way we are required to make the calculation of the MPS of the merged firm for each of the exchange ratio. Okay, next, what we will do, friends? We'll make the calculation of the profit or loss to the shareholders of both the companies for each exchange ratio. So calculation of profit or loss to shareholders of each firm. There are two exchange ratios provided to us. One is 0.20, another is 0.60. We'll work out the answer in this way for acquiring company and target company. For acquiring company and target company, we'll make a comparison of the post-merger with pre-merger. Post-merger, it is MPS of the merged firm itself. In case of the exchange ratio 0.20, it is 224. It will be compared with the pre-merger. Pre-merger, it is an amount of rupees 200. That is this one. So 224 minus 200, that is the way we have profit or loss, that is profit of rupees 24. In case of the exchange ratio 0.20, for target company it is MPS of the merged firm multiplied with exchange ratio. Because we understand that say for one of their share, they will get say the new that is say they will get the new company's equity share equal to the exchange ratio. So it is 224 into 0.20. That comes to 44.8 minus MPS of T before merger is 64. So it is 19.2 and that is a loss. This is the way we'll make the calculation of the profit or loss to the shareholders of each company for the exchange ratio 0.20. Similarly, we have to do for 0.60. However, this 24 and 19.2 can be verified once again. Acquiring company and target company. We understand that the target company is incurring a loss of 19.2 and target company's number of equity shares are 12,500. So that comes to an amount of 2,40,000. Whatever is the loss to the target company itself is the gain to the acquiring company. That is 2,40,000. What is the number of shares of the acquiring company? 10,000. Based on this, you can compute the profit to the target, that is acquiring company. 2,40,000 divided by 10,000, that comes to 24 rupees per share. This is the way we are required to calculate the answer. Take this answer of 0.2 and for 0.6 try to do answer on your own and put your answer in the chat box. So let us see that say what will happen in case of 0.6 exchange ratio. As far as acquiring company is concerned, it is 160 rupees itself. Pre-merger it was 200. So that is a loss of rupees 40. And for the target company it is 160 into exchange ratio 0.60. That comes to an amount of rupees 96. Pre-merger it was 64. That comes to 32 rupees per share. This is the way we require to calculate the answer. So again we will have the acquiring company and target company. Target company is having loss of 40 rupees per share into 10,000 number of shares. That comes to loss of 4 lakhs. Whatever the sacrifice by T itself is gained to, sacrifice by A itself is gained to T. That is an amount of 4 lakhs. Okay. What is the number of shares of the target company? 12,500. So I request again to use a calculator. 4 lakhs upon 12,500. That comes to 32 rupees per share. So please add an answer. Next question. You are required to calculate maximum affordable exchange ratio to A Limited so that MPS attributable to it is not diluted after the merger. So the question says that, say, from acquiring company point of view, calculate, say, what is the maximum affordable exchange ratio acceptable to it so that at least I will not be incurring the loss. I request you to show, that is, say, to put your answer in the chat box. So friends, we understand that over here, when exchange ratio is less, okay, less means 0.2 less than 0.6. Then in that case, acquiring company is having profit, and when exchange ratio increases, so there is a loss. So between these two, there is an exchange ratio at which the acquiring company is having no profit, no loss situation, and that is what, say, we are required to calculate over here. So I request all of you to write down answer for the fourth question. Calculation of maximum affordable exchange ratio to A Limited so that its MPS is not diluted post merger. Let us understand how to calculate the answer. I request all of you to write down answer. We know that, say, the MPS attributable to A is equal to MPS of the merged firm itself. MPS attributable to A should be at least rupees 200. MPS of the merged firm is market value of the merged firm divided by number of shares of the merged firm. So 200 is equal to market value of the merged firm is 28 lakhs. Number of shares of the merged firm is number of shares of acquiring company plus number of shares of target company into exchange ratio. What is the number of shares of the acquiring company? It is 10,000. Number of shares of the target company 12,500 into exchange ratio is equal to 28 lakhs divided by 200. So now 12,500 into exchange ratio is equal to 14,000 minus 10,000. Exchange ratio is equal to 4,000 divided by 12,500. This is a way we can make the computation of the answer. So it is 4,000 divided by 12,500. That comes to 0.32. This is a very logical method by which we can always calculate the answer. However, at the same time, we understand the two conditions are satisfied for applying the shortcut method. One is the break-even situation, and the second is there is no benefit or gain due to merger. So what we can do, we can make the calculation of the answer like this. It will be found as MPS of T upon MPS of A. What is MPS of T? It is 64 divided by MPS of A is 200. So it is 0.32. This is the way we are required to calculate the answer. Fifth question. Calculate minimum required exchange ratio by T so that MPS attributable to it is not diluted post-merger. I request you to calculate answer for the question and put your answer in the chat box. Question number 5. This time we are required to calculate the answer from the target company point of view. We understand once again logically like this. When exchange ratio is high, okay, higher than 0.2, target company is having a profit, that's good. When it is falling down to 0.2, the profit is converted to loss. We understand that say between these two there is an exchange ratio at which the target company will have no profit, no loss situation. And that is what say we are required to calculate over here. Please write down answer. Calculation of minimum required exchange ratio by target company so that it does not have loss. So it will be calculated like this. MPS attributable to T is equal to MPS of the merged firm into exchange ratio. It should be rupees 64 at least. MPS of the merged firm is market value of the merged firm divided by number of shares of the merged firm. NA plus NT into ER multiplying with the exchange ratio. 64 is equal to 28 lakhs divided by number of shares of the acquiring company are 10,000, target company 12,500 into exchange ratio which we do not know into exchange ratio once again. So 10,000, 12,500 transferred on the left hand side. Is equal to 28 lakhs into exchange ratio divided by 64. So 10,000 is equal to 28 lakhs upon 64, 43750 minus 12,500. Exchange ratio is taken common. So it is 10,000 divided by 31250. So the final answer is 0.32. This is a detailed answer once again. And we understand that we can do this answer with a shortcut method exactly like this. This is once again the shortcut method. Why? Because both the conditions are fulfilled. One, break-even exchange ratio, and the second, we understand that there is no benefit or gain due to merger. That shortcut method is also acceptable from examination point of view. So let us have the summary of the entire answer. This is what a new kind of question that we have in which we are required to calculate the market value of the merged firm. So initially we have a discussion that there are four methods by which we can compute the market value of the merged firm. The first is we may be provided with the price earning ratio of the merged firm. So what kind of information is given to us, that is what's importantly you will need to see. If the price earning ratio of the merged firm is given, then in that case first of all we make the calculation of the EPS of the merged firm. Then EPS of the merged firm into price earning ratio of the merged firm will give the MPS of the merged firm. MPS of the merged firm into number of shares of the merged firm will give the market value of the merged firm. Second, very importantly, we may be provided with the present value, discounted value of the incremental earning. Understand that say the current market value of both the firms are indicating that say the present value of their existing earning. So due to merger, if at all they are going to have say certain additional advantage, then in that case its discounted value is calculated and then it is added to the current market value of both the companies. That is the way the market value of the merged firm will be given. That is can be calculated. Third, we may be provided with the information about the change in the growth rate of the target company. Then in that case, we are required to compute the revised market value of the target company and then say it is supposed to be added to the current market value of the acquiring company to compute the market value of the merged firm. Last, none of the three information provided to us. That is what this question is. Very simply, you are required to add both the market value to compute the market value of the merged firm. That is 28 lakhs. New question, again gain or benefit due to merger, 0. It is basically indicating that say due to merger, what is the increase in the market value of the merged firm in comparison to market value of both the companies before merger. That is the way we are supposed to calculate the answer. Next question is about the MPS of the merged firm for two different exchange ratio. Exchange ratio is 0.20, exchange ratio is 0.60. For these two exchange ratios, we are required to compute MPS. MPS of the merged firm will be compared with the MPS of A Ltd before merger to compute the profit or loss. MPS of the merged firm into exchange ratio will give MPS attributable to T Ltd minus MPS of T before merger. That is the way we are supposed to calculate the answer. Since there is no gain or benefit due to merger, loss to one company itself is the gain to other company. This is what's in total that we can compute. The next two questions are the kind of break-even exchange ratio from acquiring company and from target company. You can do answer in detail or you can do answer say using the market value of both the company's price per share say before merger, and with that say we can do answer. Since both conditions are satisfied, one, there is no gain or benefit due to merger, and second, say we are required to compute the break-even exchange ratio. This is the way we are required to do answer.